Hello. So the Federal Reserve is meeting for the next 2 days. They're going to be meeting September 19th and 20th. And at their meetings, they are going to decide whether or not to raise interest rates. And right now, the word on the street is they probably won't. In fact, there are whispers that they might not even raise interest rates at their next meeting in November. So let's talk about what that means, how this whole system works, and what that means for your wallet. First of all, what is the Fed? Because a lot of news articles often throw around like the Fed, the Fed. What is it? Okay, so the Federal Reserve. Um, they are a group that sets monetary policy. They've got three branches: the Board of Governors, 12 regional banks, and the Federal Open Market Committee. Now, when we say that the Fed is meeting, we're referring to the Board of Governors. They have to meet for a very specific number of times each year. And for the remainder of 2023, they have three more meetings coming up. One that's going to be September 19th and 20th, so it's coming up in the next 2 days. The next one is going to be October 31st to November 1st. And then the final one will culminate on December 13th. Now, the Fed's job, they have what's known as a dual mandate. So they are supposed to simultaneously keep inflation low and also employment high. Now, why that's notable is because doing one often comes at the expense of the other. So if you are trying to keep inflation low, then you're necessarily raising interest rates, right? The Fed has raised interest rates in order to keep inflation low. They've raised interest rates 11 times since last year, and that's the fastest pace since the early 1980s. Now, as you increase interest rates and you make borrowing more expensive, people simply spend less. And when there's less cash in the economy, inflation starts to come down, but jobs, employment also typically start to come down because businesses can't borrow in order to grow. So that's why the dual mandate of keeping employment high and inflation low, like what the Fed tries to do is balance the two. Right now, what we're seeing is there's a slight softening in the jobs market, but overall, jobs have been very robust for the entire year. Employment is very strong. We have greater labor force participation among working age people, working age adults. There's greater labor force participation now than there was pre-pandemic. So there isn't really a concern right now about high unemployment, although there are factors such as, the auto workers strike, the SAG-AFTRA strike. There are these other factors that are the resumption of student loan payments. Those might also have an impact on inflation, jobs, unemployment, the economy. And so the Fed is watching that pretty closely. Right now, they have set the baseline rate at between 5.25 to 5.5%. And what that means is for you, how that affects your wallet is federal student loans are about 5.5% right now. If you want to borrow money to buy a car or to buy a home, those rates are averaging above 7%. And credit card, and I hope you do not have any credit card debt, but credit cards are above 20% right now. So the current interest rates are quite a bit higher than they have been, but they are unlikely to get raised any further either this week or likely even in November. As to what is going to happen in December is anybody's guess. It's too early to say. But the word on the street is essentially that the Fed is likely not to raise interest rates this week. They're going to make the official announcement on September 20, but people are expecting that they're going to say that it'll probably stay the same. And there's some speculation, although it's maybe early, too soon to make the call. There's some speculation about November as well. What that means for you is you can basically expect more of the same for a while. You can the way that loans are shaping out right now, 7% for home and auto, 5.5% for student loans. You can expect that to stay relatively consistent for the next couple of months. And so there's no chance that the Fed is going to lower interest rates. We're still a long way from that because the Fed has a target rate of 2%, and we're still not close to there. But it's likely that the rates that we're seeing right now are probably here to stick. So that is your little synopsis for today. about the Federal Reserve meeting this week and what we can expect coming down the pipeline in economic news. Thank you for joining. I'm Paula Pant from Afford Anything. Please, if you enjoyed this, please make sure you're following our YouTube channel. Please like, subscribe, leave a comment, share your love. All right. Thank you so much for watching. Have a great day. I'll catch you in the next one.